You're in a hedge fund interview and they say, pitch me a trade idea. Most candidates freeze or offer a generic stock pick with no structure. Welcome back to Derivatives and Risk Education. In this video, I'll give you a clear, professional way to build and deliver a trade pitch. We'll first look at the core framework, then I'll show you professional examples in a range of asset classes. Finally, I'll give you a ready-to-use template which you can use for any pitch. So, the core framework for a professional trade pitch. It starts with the one-line thesis. What precisely are you proposing? There are three components here. Do you go long or short? What instrument do you use? And what is the time frame? Then, why does this trade work? This is the core driver, including the mispricing and catalysts. For example, long XYZ equity into the next 3 to 6 months because the market is underestimating margin expansion from some specific driver with near-term catalysts in some events. Now the body of the pitch has three pillars. First of all, the catalysts. This is often misunderstood. The catalysts are the near-term events that will unlock the value. So for example, it's the news that will make the stock price rise. Then valuation or mispricing give evidence that the asset is cheap or expensive or that consensus is off. Then risks and mitigation. What breaks the thesis? Meaning what event would show that you're actually wrong? How do you protect the downside? And then finally, we need a trade structure. So we need an expression, including are we using equity or options? Is it an outright position or RV or relative value? Do we use cash or futures? And then also the sizing and the risk. What's the position size? What's our stop? What's our target? What's the expected risk reward? And then finally, liquidity and constraints. We need realistic execution. And for shorts, we need borrow availability. Now let's look at some simplistic versus professional examples across a range of asset classes. First of all, equity, single name. Simplistic one would be I'd go long Tesla because EV demand is growing. Professional one would be much more detailed and include all the key points we talked about earlier. Long Tesla for 3 to 6 months. The street underprices margin expansion from Model Y mix shift and software attach. The catalyst, the Q4 print and 2026 gross margin guide. Second half updates on full self-drive monetization. Valuation, at 25 times forward EPS, a discount to high growth peers, despite superior unit economics. There is upside from multiple expansion if margins surprise. The risks, supply constraints or price cuts, mitigate with a defined stop and smaller sizing ahead of the print. The structure, use equity with a 2% risk budget, stop at price X, target price Y for around a 3 to 1 risk reward. Optional, use a call spread into the earnings to cap the downside. Now let's look at an example in macro rates. Simplistic one might be rates might fall if growth slows, so I'd buy bonds. A professional one would be to receive 2-year swaps versus paying 10-year swaps, a steepener. The catalyst, dovish policy pivot as core inflation trends lower and employment softens. The front end rallies more than the long end, so the curve re-steepens. The valuation, whose tense is deeply inverted versus historical recession dynamics. The risks, sticky inflation or hawkish surprises. Hedge with payer options on 2 years. Structure, DVO1 neutral sizing, 3 to 1 target, review post next CPI or Fed meeting. Now, let's look at credit, in particular corporates. A simplistic pitch might be, I like corporate bonds because spreads are tight. Professional one, again a relative value trade, go long high quality IG credit versus short cyclical high yield basket. Relative value, so one against the other. The catalyst, a downshift in growth, high yield underperforms investment grade as default risk rises. The valuation, high yield risk premia are too tight versus earnings revisions and default cycle indicators. The risks, a soft landing scenario, so cap exposure and use CDS indices for liquidity. The structure, go long the CDX investment grade and short the CDX high yield, equalized spread DVO1. Target 30 to 50 basis points compression for around a 2.5 to 1 risk reward ratio. Finally, let's look at an FX example. A simplistic one would be I'd short the euro because Europe is weak. A professional one might say short the euro versus the dollar over 1 to 3 months. Again, we have the time horizon in there. Then the catalyst, divergent policy path and growth surprise in the US. The euro is sensitive to energy risk. Valuation, the euro is rich versus rate differentials and terms of trade. The risks, a US slowdown or dovish Fed, so we mitigate via a put spread to limit tail risk. Again, in the products, it's great to show not just long short, but using options. So in the structure indeed here, we use euro dollar put spread with a defined premium, and we're going to reassess after the non-farm payrolls and ECB. Now, how to deliver the pitch in about 2 to 3 minutes? The thesis comes first. One sentence, make sure you include an instrument, the direction, the time frame, and a driver. Then the proof is next. Include the catalysts, the valuation or mispricing, and the key risks with one crisp sentence each. The structure comes last, the expression of the position, sizing, risk reward, a stop and target, to keep it pragmatic. Language, and this can make a key difference to how the whole pitch sounds. So use role relevant terms like catalyst, spread DVO1, carry, convexity, basis, borrowing. The tone, you should have conviction but without arrogance. So only uncertainty, show how you stress test it. It's not a guarantee you've looked at the risks. But there are some very common traps and how to fix them. Number one, a vague macro narrative with no trade expression. There's a fix, make sure you name the instrument and the expression. For example, receive 2 years versus paying 10 years. Another one, no catalyst. It's cheap, without a reason to reprice. As a fix, identify specific events or inflections that will unlock the thesis. Thirdly, ignoring risks. So you should name the top risk and mitigation. You can often use options. Think about sizing or have real stop loss discipline. Another major trap is an overly long delivery. So hit the thesis, the proof, and the structure. Aim for clarity, not density. Finally, here's a ready-to-use template which you can use for pretty much any pitch. So we start with the thesis. Go long or short, some instrument, maybe use relative value over some time frame because, and then you list the core driver or the reason for the mispricing. Then the catalysts. Event 1 and event 2 should force the repricing. Then valuation or mispricing. Currently, some metric relative to maybe peer or history suggests upside or downside. Then include the risks and the mitigation. The main risk is X, so we mitigate it with some hedge or with a limited sizing or with a stop. Finally, the structure and the risk reward. So we're going to express this pitch via some vehicle. The size will be some risk budget. We put a stop at some level and we put a target to take profit at some other level, giving some risk reward. Then once you know the structure, practice this until you can deliver it cleanly in under 3 minutes, with numbers where you can and clear logic where you cannot. So, if you want to stand out in your hedge fund interviews, don't just name a trade. Pitch it like capital depends on it. Have a clear thesis, real catalysts, honest risks, and disciplined structure. Thanks for watching. Don't forget to like and subscribe, and I'll see you in the next video.